Today, we will talk about C corporations, which are a legal structure for a corporation in which owners or shareholders are taxed separately from the entity. A C corporation is a legal structure for a corporation in which the owners, or shareholders, are taxed separately from the entity. C corporations, the most prevalent of corporations, are also subject to corporate income taxation. The taxing of profits from the business is at both corporate and personal levels, creating a double taxation situation. C corp can be compared with S corporations and limited liability companies, LLCs, which also separate a company's assets from its owners, but with different legal structures and tax treatment. A newer type of organization is the B corporation, or benefit corporation, which is a for-profit firm but different from C corp in purpose, accountability, and transparency, but aren't different in how they're taxed. C corporations can pay corporate taxes on earnings before distributing their profits to their shareholders in the form of dividends if they choose to do so. Individual shareholders are then subject to personal income taxes on the dividends they receive. Double taxation is an unfavorable outcome, but the ability to reinvest earnings after taxes in the company's projects at a lower corporate tax rate is an advantage. Another clear advantage is the separation between management and the owners or shareholders. This allows longer continuity of C corporations beyond the life of the owners, which can include partial owners called shareholders. This allows the institutionalization of these corporations and the possibility of passive income through ownership for the owners. A C corporation is required to hold at least one meeting each year for shareholders and directors. Minutes must be maintained to display transparency in business operations. A C corporation must keep voting records of the company's directors and a list of the owners' names and ownership percentages. Further, the business must have company bylaws on the premises of the primary business location. C corporations will file annual reports, financial disclosure reports, and financial statements. Creating a C corporation is similar to the process of formalizing other types of business entities. These are the procedures for establishing one. C corporations limit the personal liability of the directors, shareholders, employees, and officers. In this way, the legal obligations of the business cannot become a personal debt obligation of any individual associated with the company. The C corporation continues to exist as owners change and members of management are replaced. A C corporation can have many owners and shareholders. However, it is required to register with the Securities and Exchange Commission upon reaching specific thresholds. The ability to offer shares of stock allows the corporation to obtain large amounts of capital which may fund new projects and future expansions. However, there are some drawbacks. Filing the articles of incorporation for a C corp can be more expensive than other business structures, and incur greater legal fees. They are also subject to greater regulatory scrutiny, which can increase the company's legal expenses. There are also tax considerations. The profits of a C corporation are effectively taxed twice, first when the company files its income taxes, and again when those profits are distributed as dividends. And, unlike an S corp, shareholders in a C corporation cannot deduct business losses on their tax returns. An S corporation is another type of business structure that allows a company to pass its income, deductions, and losses to its shareholders. Both a C corp and an S corp offer limited liability protection, and the process of incorporation is similar for both. The main differences relate to taxation and ownership. President Biden's American Jobs Plan increases the tax rate for C corporations in 2022. In tax years beginning after December 31, 2021, the tax rate will increase from 21% to 28%. The taxes are more complicated for tax years that started in 2021 but end in 2022. In that case, C corporations will pay 21%, plus an additional 7% for any income they earned in 2022. An S corporation is similar to a C corporation, in that both allow the owners and officers of a business to be legally distinct from the business itself. However, there are important differences with regard to taxation. an S corp is a pass-through entity, meaning that it can be used to pass profits and tax credits on to its shareholders. The profits of a C corp are taxed twice, first as corporate income and again as shareholder dividends. A C corporation should use IRS Form 1120 to report its corporate income taxes. The company may also have employment, Social Security, or Medicare tax liabilities, and these can increase the cost of filing taxes as well compared to the other forms of companies. Here are 3 key takeaways. 1. A C corporation legally separates owners' or shareholders' assets and income from that of the corporation. 2. C corporations limit the liability of investors and firm owners, since the most that they can lose in the business's failure is the amount they have invested in it. 3. C corporations are mandated to hold annual meetings and have a board of directors that is voted on by shareholders. Hope this would help. Thanks for watching.